Right now, somewhere in the United States, a bank is lending out money that belongs to you. Not a copy of your money, not a reserve fund set aside in your name. Your actual deposit, the dollars you transferred in, the paycheck you direct deposited last Friday, the savings you have been building for 3 years. A portion of that money is currently being used by someone you have never met for a purpose you were never told about, generating a return that goes primarily to the institution holding it. This is not fraud. It is not a loophole. It is not a recent development. It is the legal foundation on which every commercial bank in the United States is built, and it has been this way for over a century. The more important question is not whether your bank is doing this. It is what happens when every depositor in the same bank decides they want their money back at the same time. That answer is more complicated and more consequential than most people realize. To understand how this works, it helps to start with the legal relationship between you and your bank, because most Americans assume it is something it is not. When you deposit money into a checking or savings account, you do not retain ownership of those dollars in the way you retain ownership of a car or a house. What you have done legally is make an unsecured loan to the bank. The bank takes title to your deposit. In exchange, it gives you a liability, a promise to return an equivalent sum on demand, plus any agreed interest. Your account balance is not a record of money sitting in a vault with your name on it. It is a record of what the bank owes you. This legal structure was not invented to deceive depositors. It was established because it is the only arrangement under which a bank can function as a bank. An institution that simply stored your money, taking it in, keeping it idle, returning it on request, would have no mechanism to generate the revenue needed to pay staff, maintain operations, or offer you any return. It would be a warehouse, not a bank. The bank's business model depends on deploying the deposits it holds. It lends to home buyers, businesses, and consumers. It invests in government securities. It participates in financial markets. The spread between what it earns on those deployments and what it pays depositors is how the institution survives. This is not unique to the United States. It is the operational model of commercial banking in every major economy on Earth. The system that governs how much of your deposit a bank can deploy and how much it must retain is called fractional reserve banking. The core principle is straightforward. Banks are not required to hold every dollar deposited. They are required to hold a fraction of it. The rest can be lent out, invested, or otherwise deployed. For most of the 20th century, U.S. banks were required to hold a specific percentage of their deposits in reserve, either as cash in their vaults or as deposits at the Federal Reserve. That reserve requirement served as a regulatory floor, a minimum threshold of liquidity the system demanded each bank maintain. In March 2020, the Federal Reserve reduced that reserve requirement to 0 for all U.S. commercial banks. The explicit rationale was to encourage maximum lending during the economic disruption of the pandemic. The reserve requirement has not been reinstated since. This does not mean banks now hold nothing in reserve. Banks maintain capital buffers for regulatory and operational reasons. Large banks are subject to liquidity coverage ratios and stress testing requirements that constrain how aggressively they can deploy depositor funds. But the statutory floor that once defined the minimum fraction a bank must hold has been eliminated. What this means in practice is that the fraction in fractional reserve banking is no longer a fixed regulatory requirement for most U.S. banks. The constraint is now market-based, capital-based, and confidence-based. And confidence, as the system has demonstrated repeatedly, is not always stable. The mechanics of fractional reserve banking produce an effect that surprises most people when they first encounter it. The money supply expands far beyond the amount of physical currency that actually exists. The mechanism works like this. A depositor places $1,000 in Bank A. Bank A holds a fraction in reserve and lends the remainder, say $900, to a borrower. That borrower deposits the $900 in Bank B. Bank B holds a fraction and lends the remainder to another borrower. That borrower deposits their funds in Bank C. The process continues. At each step, new deposit balances are created. The original $1,000 has produced multiple deposit accounts across multiple banks, each representing a claim on funds. The total of those claims is significantly larger than the original deposit that initiated the chain. This is not a malfunction of the system. It is the designed output of fractional reserve banking. The expansion of credit, the creation of new purchasing power through the lending cycle, is precisely what the system was constructed to produce. It is how an economy with a finite supply of physical currency can support a volume of economic activity many times larger than that currency supply alone could sustain. The risk embedded in this design is also precisely what you would expect. Every claim in that chain is a promise, and promises depend on the continued confidence of the people holding them. In normal conditions, a bank's depositors do not all demand their money simultaneously. Some withdraw, others deposit, and the flows roughly balance. The bank's fraction in reserve is sufficient to meet daily demand without difficulty. The system functions because most depositors, most of the time, have no reason to test it. The moment a significant number of depositors begin to doubt whether their bank can return their funds, the dynamic changes entirely. Each individual withdrawal is rational. If the bank might fail, withdrawing first protects your deposit. The problem is that when enough individuals act on that same rational calculation simultaneously, the failure they feared becomes the outcome their collective action produces. This is the bank run, a self-fulfilling crisis triggered not necessarily by actual insolvency, but by the perception of possible insolvency, spreading faster than any institution can contain. The United States has experienced this pattern repeatedly. The bank panics of 1873, 1893, and 1907 each demonstrated the fragility of a system built on confidence rather than full collateralization. The bank failures of the Great Depression, more than 9,000 banks collapsed between 1930 and 1933, showed what happened when that confidence broke at scale across an entire national system. The most significant bank run in recent American history did not involve lines of depositors on a sidewalk. It happened digitally, in hours, and it took down the 16th largest bank in the United States before regulators could fully respond. In March 2023, Silicon Valley Bank, a California institution with $209 billion in assets, collapsed over the course of approximately 48 hours. The proximate cause was a mismatch between the bank's assets and its liabilities. SVB had concentrated a large portion of its deposit base into long-term government securities purchased when interest rates were near zero. When the Federal Reserve began raising rates aggressively in 2022, the market value of those securities declined. The bank was sitting on significant unrealized losses. When SVB announced it needed to raise capital to address those losses, the announcement itself triggered the crisis it was designed to prevent. Depositors, many of them technology companies with accounts well above the FDIC insurance limit of $250,000, began withdrawing immediately. What followed was not a slow-moving traditional bank run. It was a digital acceleration of the same mechanism. Depositors initiated transfers through mobile apps and online banking platforms. Within hours, the bank was facing withdrawal requests that exceeded its liquid assets. Within 48 hours, regulators had seized control. Approximately $42 billion in deposits was withdrawn in a single day, the largest single-day bank run in U.S. history. The Federal Deposit Insurance Corporation ultimately guaranteed all deposits at SVB, including those above the standard $250,000 insurance limit. That decision prevented broader contagion, but it also raised a structural question the system has not fully resolved: what the actual limits of deposit protection are when the failure is large enough and fast enough. The Federal Deposit Insurance Corporation was created in 1933 specifically to address the confidence problem at the core of fractional reserve banking. By guaranteeing individual deposits up to a specified limit, the FDIC removed the rational incentive to run. If your deposit is guaranteed regardless of what happens to the bank, there is no first-mover advantage in withdrawing early. The system has functioned with relative stability for most of the 9 decades since. Bank failures occur. They occur every year, but they have not cascaded into systemic collapse since the Depression, in significant part because the guarantee changes the calculation for ordinary depositors. What the FDIC guarantee does not change is the underlying structure. Your bank is still deploying your deposit. The fraction it holds in reserve is still determined by operational judgment and regulatory capital requirements, rather than your individual preference for security. The legal relationship between you and the institution holding your money is still that of creditor and debtor, not owner and custodian. The system works because confidence is stable most of the time. Confidence is stable because the guarantee is credible. The guarantee is credible because it has been honored consistently. That chain of dependency is not a weakness in the design, it is the design. Understanding that design does not require you to distrust your bank. It requires you to understand what kind of institution a bank actually is, what it does with your deposit, why it does it, and what mechanisms exist to protect you when the confidence that holds the system together becomes uncertain. Your money is in the system. The system is built on the assumption that you will not need it all at once. And for the vast majority of depositors, in the vast majority of circumstances, that assumption holds. The question the system lives with, quietly, permanently, is what happens on the days when it does not.